The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar entitled Captive Insurance Loses Again. The webinar will last approximately 15 to 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thanks, Jennifer, and hello, everyone. Thank you for joining us for today's session, Captive Insurance Loses Again. Before we get too deeply into the captive insurance case of Caylor Land and how the taxpayers there ran afoul of the IRS, let's decide what we're going to talk about next month. We've got 3 choices for the June webinar. We hold these webinars the first Wednesday of every month. They are open to everyone. They are free of charge. The 3 choices for the June 2nd webinar are C Corporation Tax Advantage, the tax aspects of chronic and terminal illness accelerations, and then HSAs in a nutshell. I'll ask Jennifer to go ahead and open the poll and ask you to vote and pick which choice we should do for next month's webinar. I'll go ahead and give you about 20 seconds. Anybody else wants to vote? You got a second? All right, let's go ahead and close the poll. Next month, we will talk about the tax aspects of chronic and terminal illness accelerations. Thank you for participating in that, and thanks for your support of our webinar series. As I mentioned before, and Jennifer also mentioned, we're going to talk today about another captive insurance loss. This is another court case in which they've lost. Captive insurance schemes have been under a great deal of scrutiny lately. The IRS has put them squarely in their crosshairs. They put certain kinds of micro-captive arrangements, abusive micro-captive arrangements, in their list of dirty dozens tax scams back in 2014. And in 2016, they got a little more detailed. They identified certain kinds of micro-captive transactions as having the potential for tax avoidance and tax evasion. And so promoters have been put on notice that captive insurance arrangements, particularly those involving life insurance, are going to get a lot of IRS scrutiny. And also captive insurance arrangements that are implemented kind of cavalierly run the risk of being attacked by the IRS. The IRS has a winning record in court cases that it's decided to pursue against certain kinds of captive insurance arrangements. And let's talk about some of the history there. In the case of Salty Brine versus United States, the Court of Appeals decided that that the district court's decision to disallow premiums paid to a captive was the right decision. The court ruled that the premiums were not ordinary business expenses because the premiums were not for covering insurable risks, and so the deduction was disallowed in Salty Brine. In the Abrahami case, they also decided that this was not a valid captive insurance arrangement, even though the Abrahamis apparently tried to have their operating companies insure real risks. The tax court didn't buy it, decided that the way that it was set up was not real, and the premiums paid were not tax deductible. In a third case, Syzygy versus Commissioner from 2019, again, the tax court was called on to decide whether or not the captive insurance arrangement was legitimate. The court decided that the company was not engaged in the legitimate business of insurance, and therefore the premiums paid to it were not tax deductible. So you can see a pattern here where the courts have been called on to examine micro-captive arrangements that the IRS has decided to attack as illegitimate. There's a pretty good history of the courts taking the IRS's side in those cases. And the Caylor Land development case, which is the one we'll talk more about in a few minutes, is another example of this. Again, 2021 case where the court said the micro captive, the small insurance captive company, wasn't providing real coverage, and therefore the premiums paid to it were not tax deductible. Before we get into the details of the case, let's talk about captive insurance companies and talk about why they have been popular and how they work from at least from the business owner's perspective. So a business owner that has a profitable operating company creates a captive insurance company, a CIC. And the nominal purpose of creating this captive insurance company is to insure certain kinds of risks that the profitable operating company has, for which commercial insurance is either not available or too expensive or doesn't cover perfectly. There are some exclusions that the captive is designed to kind of fill in. So the captive is designed to provide supplemental kind of coverage, liability protection that supplements what commercial insurance provides. So the deal is that the operating company pays premiums for the insured risks to the captive insurance company. The most premium that can be paid is $1.2 million under current rules, but assuming that that limit is not surpassed and other requirements are met, at least arguably, we've got a legitimate captive insurance arrangement that can be put together by a profitable operating company. So the operating company pays the premium to the captive company that is owned by usually the same people that own the operating company. That's why it's referred to as a captive insurance company, because they're both the operating and insurance company are under the same kind of control. And so those premiums are paid to the captive insurance company. Wouldn't be a big deal if the captive insurance company had to declare those premiums as income But one of the advantages of having this captive insurance company is that the captive insurance company is allowed to create reserves. And most of the premium that it receives are used to create those reserves for the potential future claims that are going to be made by the profitable operating company. So it at least nominally does act as a real insurance company. Premiums are paid by the operating company to the captive, and the captive uses most of those premiums to create a reserve to pay claims later on. And so the operating company gets a tax deduction, while the captive doesn't have to declare any income, at least upfront, for amounts that are put into reserves. So what's the problem? Why does the IRS not like these things very well? Well, the big issue from the IRS's perspective is that in a lot of these micro-captive implementations, there are promoters that are pushing the profitable company and the profitable company's owners to create captive companies. And a lot of times they participate in arrangements that don't act like real liability insurance. Now, what are some examples of how that might look? Well, one example is that the coverage that the captive provides doesn't really match the actual business needs of the operating company. That's one potential failure. The second potential failure, and this is a big one, a lot of times under the captive arrangements, the amount of premiums that the operating company pays are matched to their desire for deductions rather than actual premiums based on real insurable risks. And I mentioned earlier that $1.2 million in premium is the maximum that can be paid, and you still have the captive recognized under favorable IRS rules. A lot of times the operating company buys insurance that is that has a premium that is exactly that amount, $1.2 million a year, rather than whatever amount would be dictated by the risks that it is seeking to cover. Third example of ways in which micro-captives don't act like real insurance is that the administration is not like a real insurance company. There are flaws in how that works that make it look like they're doing it on the fly rather than operating as a legitimate insurance company. And so we'll see some examples of that in the Caylor Land case in a second. But before we get there, if micro-captive implementations kind of look like this, question is, how does life insurance get involved? Because a lot of life insurance people have been promoters of captive insurance arrangements. And the answer is really as an ancillary to this third part, where the income received by the captive is not taxable at all because it goes to reserves. Well, you got to go park that money somewhere. You could park it, I suppose, in a checking account. Interest rates aren't that great, but one place that is popular to park the reserve money from the captive is in a permanent life insurance policy. And so the permanent life insurance policy resides inside of the captive. It is paid for by tax deductible money paid by the operating company, and the policy that is owned inside of the captive, no one pays income tax on it, at least up front. And so in a way, a captive implementation, if it works as advertised, where the money is parked in a permanent life insurance policy, that kind of approach being the holy grail of life insurance. You may have heard me use this theme before. From my perspective, the holy grail of life insurance planning is a plan that generates a deductible premium for the business and no inclusion in anybody's personal income of the premium amount. Now, it's not completely clean for even in a captive implementation that there will never be any personal income tax liability, but not having or getting a deductible premium on the front end and no inclusion as the premium is being paid is a big deal, and in a way that represents something approaching the holy grail of life insurance planning. Well, obviously the service doesn't like casual implementations that are life insurance oriented. They want to see real details to these captive arrangements. And so let's talk about the Caylor Land court fight and some of the background information to get started. Bob Caylor and his son Rob built a thriving construction business which had multiple entities. Caylor's had a history of purchasing liability insurance related to their businesses. They paid 60 grand or so each year for liability coverage, commercial liability coverage, and that coverage wasn't perfect. And so on average, they incurred uncovered losses of about $50,000 a year. Some years more, some years less. The average worked out to be about $50,000 per year. And the Caylors, Bob and Rob, went to a seminar, heard about CICs, captive insurance companies, micro captives. They decided that they would hire the promoter of that idea to manage a captive implementation for their own companies. And so in December of 2007, the Caylors created an offshore captive insurance company that was incorporated, and Rob was the owner of that company. So the date's important, December of 2007, they create the captive company. And on the same day, Caylor Construction, their main operating company, pays the captive $1.2 million in premiums, or in purported premiums, which the Caylors deducted as an insurance expense on the company's 2007 income tax return. So in December of 2007, the insurance premium is paid and it's taken as a full deduction on the 2007 income tax return. Well, what are the problems? The problems are the first problem is there'd been no underwriting to justify a $1.2 million premium for 2007. The second problem is that there were no policies issued for 2007 until after the coverage period had expired. Same thing with 2008. There was no underwriting until coverage for 2008 had already expired. Same or similar problems for 2009 and 2010. Nobody was treating this like it was legitimate insurance. The timing was all wrong to justify asking the IRS to honor what had gone on. And 2011 was not much different. Underwriting approval and policies for 2011 were all done late. What are the additional problems that came up? The Caylors companies paid exactly $1.2 million in annual premium for 2007 through 2010. Coincidentally enough, the maximum amount for a micro captive wasn't matched up to underwriting, matched up with the maximum desired deduction while still complying with the IRS's rules. The Caylors paid $1.2 million in premiums despite the fact that their average uninsured claims prior to the formation of that captive was about $50,000 a year. So they were paying more than 20 times more premium compared to their actual claims experience prior to having the captive insurance company. The Caylors were moving money around between their main operating company and a bunch of others in an effort to try to maximize the insurance company and the insurance amounts and justify the coverages that were being paid for. The court didn't really like that. And the claims process was sloppy. Consolidated did pay some actual claims associated with the Caylor's companies, but the process was not an arm's length kind of transaction between an insurance company and the insured business. It was done sloppily. For example, in two instances, there were losses that were incurred and no documentation was provided, but the requested amounts were reimbursed by the captive insurance company anyway. Finally, the court had enough. The court heard enough. The court said no, tax deductions were not proper for these premiums because they weren't really premiums for coverage, and therefore they were not deductible by the Caylor's companies. And furthermore, the court decided that the Caylors did not act in good faith, and so penalties were in order in this particular case. And so that adds to the lineup of IRS-oriented decisions in the captive insurance world. The Caylor Land case says this captive insurance arrangement did not work, and therefore all of us kind of need to think about that and pay attention to that if we run into clients who have implemented captive insurance arrangements. So what are the conclusions to draw from the Caylor Land case? Micro captives combined with life insurance do offer the potential for the holy grail, but the IRS doesn't like them, and captives have got more attention. So it's hard to imagine circumstances where someone is going to successfully promote the idea of combining captives and life insurance in a package going forward. It won't work that way. If you're going to implement a captive as a profitable operating company, you got to start with doing the captive right and making sure the administration and pricing is all taken care of in the right way. Fortunately, I suppose there are fewer promoters. Captive implementation ultimately has not turned out to be as attractive as some of the promoters would have had us believe. High costs of implementations associated with implementing captives, and the IRS scrutiny makes these things really, really potentially expensive, and therefore it's hard to imagine that many people will be promoting these in the normal course of their business. So that's a summary of the Caylor Land case, a summary of one more case in which the IRS beat up on captive insurance companies. I'd like to thank you again for joining us today. If you have any questions about today's presentation, feel welcome to contact us. And at this point, I'll turn the program back over to Jennifer to close us out. Jennifer?
Thanks, Linus, and thanks for joining us today. And don't forget to join us next month for tax aspects of chronic and terminal illness acceleration. If you would like to receive supporting materials for today's presentation, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You can also email us questions related to today's webinar. If you would like to subscribe to our YouTube channel, please do so. You can catch up on all of our most recent webinars there. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.